Good afternoon, everyone. I am Eric Lufer, the Research Director for the Citizens Research Council of Michigan. I'd like to welcome you to CRC's webinar to discuss our analysis of Proposal 1, Conversion of State Use Tax to New Local Tax for Local Government Personal Property Tax Reimbursement. This webinar is being presented by the Citizens Research Council of Michigan. CRC is a statewide, nonpartisan public affairs research group. This is CRC's 98th year of operation, a longevity we attribute to our promotion of sound public policy for state and local governments through accurate, independent, and objective research. We are a private, not-for-profit entity, and we rely on the charitable contributions of foundations, businesses, corporations, and individuals. As a nonpartisan, independent organization, CRC does not support candidates for public office or support or oppose ballot issues. We are presenting this information today based on our tenet that we think better information leads to better public policy, and in this case, you, the citizens, are the public policy makers. I'd like to encourage all of you to join our circle of supporters and help us to continue to provide high-quality, independent information on important public policy topics in Michigan. Please note that we are recording this webinar and we will post it on our webpage where it will be available for future viewing. We have everyone but the presenters on mute, so we will not be able to hear if you speak. To ask a question, please type the questions into the question pane that appears on the GoToWebinar software. You can type these questions in at any time. If you have any technical problems during the webinar, please let us know by calling 734-542-8001. After the webinar, you will receive an email soliciting your feedback, and we would very much appreciate any feedback you have so we can hone the skill and be better at presenting the information over the internet. Today's webinar on Proposal 1 will be presented by Bob Schneider, CRC's Director of State Affairs. Bob joined CRC about 1.5 years ago after working for many years with the House Fiscal Agency. He's been doing great work helping us track state fiscal conditions and is a real asset to our research team. This presentation will deal solely with Proposal 1 on personal property tax reform. We know that at least 2 other questions are currently certified for the November general election, and other questions may be added. CRC will publish analyses of these questions closer to that election and conduct another webinar or 2 to discuss those issues in the weeks leading up to the November election. With that, I would like to turn things over to Bob.
Thank you, Eric, very much, and welcome to all of you to this afternoon's webinar. As Eric indicated, today we're going to be reviewing Proposal 1, the only statewide ballot question on the August 5th ballot. And again, this is essentially a referendum on recent legislation that brought new personal property tax exemptions to Michigan businesses. We're going to start with a very quick summary of the proposal. What is it that we're going to be voting on? And then we're going to do some background on key elements of the proposal. And my hope and our hope today is that you'll leave the webinar with a fuller understanding of the proposal and the related issues surrounding the proposal. So let's start with a quick summary of Proposal 1. What is it exactly that we're going to be voting on August 5th? The proposal is essentially a referendum vote on Public Act 80 of 2014. That act was a key piece of broader legislation that eliminated wide segments of the personal property tax on the business community. It did that specifically in 2 ways. First, it converts a portion of the existing state use tax to a new local tax, and the revenue from that new local tax then goes to a special authority for reimbursement to local governments for the revenues that they will be losing through the PPT. Why is it that we are voting on Proposal 1? The new local tax under Michigan's Constitution, as we'll explore in greater detail later, requires voter approval under headly provisions of the Constitution for any new local tax. Another important item to note, Public Act 80 was tie-barred by the legislature to other legislation implementing the various PPT, personal property tax reforms. So if Public Act 80 is not approved by voters, the rest of the relevant legislation is repealed as well. So in summary there, you see if Proposal 1 is approved, the use tax conversion to the new local tax does indeed go into effect. Eligible businesses will get personal property tax relief. Local governments will receive reimbursement for most of their PPT losses. If the proposal is defeated, personal property tax legislation is repealed as a whole, there will be no business tax relief, no need then for local reimbursement, and the existing state use tax remains in its current form. Let's do a quick outline of what we're going to cover today in the webinar. Before we get into the details of the legislation, we're going to talk a little bit about background on the personal property tax and the property tax in general. That'll include a discussion of the relevance of the property tax for local governments, arguments that have been made for the repeal of the personal property tax, and again, its significance as a local revenue source. We're going to look a little bit at the legislation itself that implemented personal property tax relief for eligible businesses. We'll look at the local reimbursement process that was established in 2014 legislation that will ensure that local governments are reimbursed for at least a large majority of their personal property tax losses. Public Act 80 was directly a part of that 2014 legislation. And then we'll look at some key considerations that ties things together and kind of explains what does this all mean in the big picture. So before we get into the details of the proposal, it might be helpful to talk briefly about property taxes in general. Property taxes are a very important revenue source for local governments. Local governments are heavily dependent on property tax revenue. In April, the Citizens Research Council issued its outline of the state tax system. If you look into that outline, you'll see that for tax year 2012, $10.9 billion in local revenue was generated from taxes that originate from the General Property Tax Act. Property taxes in general are levied on two types of property: real property, what we generally think of, land, buildings, and personal property. Personal property are movable items such as furniture and equipment. And it's also important to note property is classified in accordance with its use. We have both for real property and personal property. Property is classified as residential, agricultural, commercial, industrial, utility, and that classification can affect its tax treatment. So for instance, residential and agricultural personal property are exempt from property taxation. The personal property that you and I have in our homes, for instance. Industrial personal property is exempted from the state education tax and from local school operating levies. Commercial personal property is exempted from 12 mills of the local school operating levies. So the tax treatment of property often depends on its use. Today we're going to be talking about exemptions to the personal property that primarily affect commercial and industrial personal property. Now let's look specifically at personal property taxes. Again, personal property is included in the tax base for businesses. It's exempted, as we just said, for residential and agricultural properties, as we noted on the last slide. Personal property, as opposed to real property, is defined as property not affixed to the land. So for businesses, this includes everything from machinery and equipment to tools and computers and furniture used in the business. While most property tax revenue comes from real property, personal property is also an important component. The Senate Fiscal Agency, in a memo in 2011, estimated that the personal property tax generated on commercial and industrial personal property generated roughly $844 million. About $57 million of that accrued to the state through the state education tax to the school aid fund. The remainder, $787 million, went to counties, municipalities, school districts, community colleges that have local tax levies. Now, the business community has long argued that the personal property tax is a bad tax and that it's a particularly onerous tax for businesses in that it taxes productive assets like equipment and machinery. And as such, they argue that the tax creates a disincentive to invest. It adds to the cost of capital when a business is considering buying new equipment and perhaps having to finance that equipment through loans or other borrowing. It reduces the return on investment to that investment in equipment. And as a disincentive to invest, that then stifles business expansion, and that then stifles the related job creation that may come with business expansion. Another argument that's been posited is that the personal property tax represents a form of double taxation. If a business buys a new piece of equipment, that business will pay sales tax at the time of purchase on that piece of equipment. With the personal property tax, the business would continue to pay that tax annually on that same equipment. That tax burden would decline over time as the equipment depreciates, but there would still be an annual assessment in addition to the sales tax. So for these reasons, in short, the personal property tax repeal has been a long-standing goal of the state business community. One hurdle that has been difficult to overcome in past efforts to implement personal property tax reforms has been local government revenues. How can we achieve personal property tax relief without greatly damaging local finances? And in the past, that hurdle has made it very difficult to achieve any personal property tax reforms. Statewide, the taxable value of commercial and industrial personal property accounts for about 7% of the total property tax base for all property. And we'll see it in the future. In short, I'm going to use C&I for commercial and industrial property in future slides, so recognize that acronym. So about 7% statewide, but that reliance on commercial and industrial personal property varies dramatically across local units. CRC looked at Treasury reports. We found about 2/3 of local units have commercial and industrial personal property tax bases that account for 1% or less of their total property tax base. For the top 30 cities and townships, ranked according to the percentage of personal property as a percentage of the property tax base. Those 30 cities and townships all had commercial and industrial personal property accounting for at least 30% of that property tax base, and it will be communities such as those that would be greatly affected by a personal property tax repeal that was not accompanied with some form of reimbursement. Here we'll see some examples of those types of commercial and industrial personal property dependent units. The top 5 communities that you see listed here, municipalities, have the highest percentage statewide of commercial and industrial personal property as a percentage of all property. You'll see the city of Carson City, Riverton Township, Guilford Township, North Star Township, Minden Township, all with 60% plus reliance on commercial and industrial personal property as a component of their local tax base. The next 5 communities, several cities among them, are the communities with the largest dollar amount of commercial and industrial personal property, taxable value of commercial and industrial personal property in the state. And again, all of them have at least 30% of their local property tax base relying on commercial and industrial personal property. And again, those are examples of communities that without reimbursement would be seriously impacted by any personal property tax repeals. With that background, let's look at what happened in 2012 as the legislature enacted a package of bills to reduce personal property tax liabilities for Michigan businesses. The relevant legislation does 2 things. First, it exempts industrial personal property and some commercial personal property from the property tax base. For small property tax holders, those businesses with property valued at $80,000 or less within the specific local tax collecting unit. Those exemptions have already begun. The exemptions for small personal property tax holders began January 1st, 2014, are effective for tax year 2014. For other businesses, the legislation will provide a exemption for industrial personal property and the eligible commercial property beginning in fiscal tax year 2016, and that will be phased out over time so that all eligible personal property receives its full exemption in tax year 2023. On the next slide, we'll take a little more detailed look at the schedule for that phase out. The other component of the legislation was local revenue reimbursement, and this was achieved primarily through the Public Act 80 conversion of a portion of the state's use tax to a new local tax. As background, real quickly, the state's use tax is a 6% tax that we pay as sort of a companion to the state sales tax on things like internet and catalog sales, phone calls, on certain used car sales. Rather than paying the sales tax, we pay the 6% use tax. A portion of that state tax would be converted then to a new local tax, and the revenues from that new local tax are dedicated to local reimbursement for personal property tax losses for communities such as those we talked about earlier. For small property holders, the personal property tax exemption is already in effect. Again, it began in January 2014, applicable to tax year 2014. And again, this applies to businesses with a true cash value of $80,000 or less of personal property. Now, in order to gain the exemption, the business taxpayer must file an annual affidavit with their local assessor to claim the exemption. It is not automatic. And another thing worth noting is that the $80,000 threshold does create a cliff effect. If a business in a specific tax collecting unit has $79,999 in commercial and industrial personal property, they would receive the full small property holder exemption for that locality. If they have $80,001 in commercial and industrial personal property, they would get no exemption on any of the personal property. So there is a cliff effect that is going to be important to business taxpayers. For other taxpayers not eligible for the small property exemption beginning in tax year 2016, these larger personal property holders will, with qualified property, will also qualify for an exemption. Again, that begins in tax year 2016, and property continues to be the exemption begins to be phased into other properties until all eligible property is exempt in 2023. The exemptions will apply to industrial personal property, all industrial personal property, and specific commercial personal property, and that would include commercial personal property that is used predominantly in industrial processing or direct integrated support functions, and those include functions such as research and development, engineering, testing, storage. It's any of those categories that meet the definition of direct integrated support in the legislation. The chart on this slide illustrates how the phase-in process will work for these larger personal property holders. So as you'll see in the first column of the chart, the first column is tax year 2016. In tax year 2016, exemptions for eligible personal property will apply to new property purchased and placed in service during 2013 or after, so that's the box at the bottom, and also older existing property placed in service in 2005 or earlier, the top box. Then in tax year 2017, which is covered in the second column, exemptions will add eligible personal property placed in service in 2006. And then as each tax year progresses, one additional year of of property placed in service will be added until tax year 2023, at which time all of the eligible property, either industrial or meeting the eligibility criteria for commercial personal property, will receive their full exemption. Now, larger personal property holders that don't meet the small property holder criteria will be subject to a new state essential services assessment. This will be a new statewide tax levied against the acquisition cost of the newly exempted personal property. Again, this does not apply to those who qualify for the small personal property tax, personal property holder exemption, but to those who only to those who don't meet that criteria. The assessment is a state tax. Revenue goes to the state's general fund. We have revenue estimate. It's listed there as $20 million as the phase-in begins in fiscal year 2016, rising to $73 million in fiscal year 2017, and eventually to about $117 million in the long run, about fiscal year 2028. The tax will be assessed at a millage rate based again on the acquisition cost of the property that will start at 2.4 mils for newer property, 1 to 5 years old, and as the property ages, the millage rate of the assessment will fall to 1.25 mils and finally to 0.9 mils once the property is 10 years out from its acquisition date. The Michigan Strategic Fund will have the authority to waive some or all of this new state essential services assessment for for claimants who can demonstrate a plan to make substantial new investments in personal property in Michigan that are at least have a value of $25 million. So the purpose behind the assessment is to help restore some of the state's general fund revenues to offset the cost to the general fund of reimbursing local governments. Now let's take a look at the provisions regarding the local reimbursement. As we noted, Proposal 1 is a direct referendum on Public Act 80 of 2014, and that act established the new local community stabilization share tax. The act splits the existing 6% state use tax into two new distinct taxes: the local community stabilization share tax, levied by a new special authority, a local community stabilization authority. The proceeds of the tax to be used to reimburse local governments for their personal property tax revenue losses. The other tax would be a state share tax, and that would continue to be levied by the state, as is the existing state use tax, and the revenues there would go for state purposes. The local share tax is a local tax. The tax rate for the local, and I am going to in the slides that follow, the local community stabilization share tax, I'll refer to that in short as a local share tax. So know when you see local share tax, it means the local community stabilization share tax. So the local share tax is a local tax. The Michigan Department of Treasury would be charged with calculating its rate annually, and that rate would be set at a rate necessary to achieve specific revenue targets that were set in the legislation. And those revenue targets are then based on estimated needs to reimburse local governments for their personal property tax losses. Revenues from the new local share tax are estimated at $96 million in the first year of the phase-in of the larger personal property holders in fiscal year 2016. It goes up over time, eventually reaching $572 million in fiscal year 2028. After that time, the revenue targets that are used to set the local share tax rate are adjusted by a 1% growth factor. Now, the local community stabilization share tax is one component of the two new distinct taxes. The state share tax is the other component, and the state share tax rate is then simply equal to the current 6% use tax rate minus the computed local share tax rate. So essentially, we're redirecting a portion of the current state use tax to the new local share tax. The remainder of the state use tax becomes the state share tax. It's important to note there's no change in the overall tax burden to citizens. The state share tax rate and the new local tax rate would add up to the current 6% use tax rate. For folks interested in school finance, it's also important to note that the new local tax does not affect the allocation from the current use tax to the state school aid fund. So the use tax currently has a 2% allocation to the school aid fund. The local tax comes out of only the 4% base that goes to the state's general fund, does not affect the 2%, the added 2% that is contributed to the state school aid fund, and it originated under Proposal A, school finance reforms. The related legislation also then created a new special authority entitled the Local Community Stabilization Authority to collect and distribute revenues from the new local share tax. So the Local Community Stabilization Authority will be responsible for the collection and distribution of the new tax, as well as it will take over some responsibilities from an existing authority, the Metropolitan Extension Telecommunications Right-of-Way Authority, which is involved in streamlining permitting processes for telecommunications right-of-way. It will have both those responsibilities under its wing. The authority is established under Article 7, Section 27 of the Michigan Constitution, which allows for the creation of additional forms of government in metropolitan areas to facilitate functions. The LCSA would be a unique entity. It would have statewide boundaries, but it is designated as a local unit of government. So essentially it is a statewide local unit of government, and it will be governed by a 5-member council appointed by the governor. So with that review of both the exemptions and the reimbursement mechanism for local governments, let's take a look at some of the numbers behind the proposal. The personal property tax exemptions are estimated to cost local governments $127 million in fiscal year 2016. That's the first year, again, that the exemptions will apply to larger property holders. Those losses are expected to climb to $414 million in fiscal year 2017 as the phase-in process continues, eventually reaching $577 million in fiscal year 2023 and $603 million in fiscal year 2028. Now, the losses that we talk about here include two things. First, losses from the state education tax and local school operating levies, and those losses will be offset by new deposits from the state share tax to the school aid fund. Both those losses essentially impose new burdens on the school aid fund. The state general fund through the state share tax will basically meet those losses. The state share tax revenues will be deposited in the school aid fund to hold it harmless from those losses. The remainder of losses to counties and municipalities, community colleges, will all be reimbursed from the new local share tax created under Public Act 80 and administered by the new authority. Those revenues will be used to offset some portion of those losses. The legislation also prioritizes local reimbursement administered through the Local Community Stabilization Authority. The first priority for local share tax revenue will be 100% reimbursement for revenue losses attributable to the items in the 5 bullets. That would be basically school-related millages, ISD millages, millages related to tax increment financing authorities, such as downtown development authorities, the losses from the small personal property holder exemption, and then revenues used, locally to finance essential services, and the legislation defines essential services as police, fire, ambulance, and jail services. Once those prioritized reimbursements are made, any remaining revenue from the local share tax would be distributed by formula to cover remaining local losses. So those related to revenues for non-essential services, community college millages, library millages, things such as that. So with that, let's take a look at some key considerations and some key questions that have arisen about Proposal 1. First, why are we voting in the first place on this issue? The state legislature specifically added a requirement to Public Act 80 that created the local community share tax, requiring a statewide vote on the conversion of the state's use tax to this new local tax. Why? The legislature did not directly provide a reason why they decided to add that voting requirement, but an examination of the state constitution shows in Article 9, Section 31, under the Headley provisions of the Constitution, local governments are prohibited from levying any tax not authorized by law or charter when this section is ratified, which was in 1978, without the approval of a majority of the qualified electors of that unit of local government voting thereon. The local share tax, in this case, is taken from an existing state use tax, but it's still a new local tax. And then further, the LCSA is a statewide entity, but it is a local government. So we have a local government levying a new local tax. It's a fair interpretation of Section 31 that would require voter approval for the new local tax. And now, since the local government here it comprises the entire state, thus a statewide vote on this issue. There's also been questions on the new authority and its role in the process. The Local Community Stabilization Authority is a statewide entity administering a statewide tax. Yet again, it's designated a local government, and the statewide tax is designated as a local tax and local revenue. It would seem a simpler solution would be to have some new component unit of state government to collect this state tax that would be state revenue, and that revenue could be distributed to local governments to reimburse them for lost personal property tax revenues. Why this somewhat unique arrangement with a statewide local unit of government and a special new local tax? The answer likely lies in that local governments want some assurances that promised reimbursement will be realized. The local tax collected by this new local authority means revenues do not flow to the state treasury. They're not state revenue. The revenues are also not subject to annual appropriations by the state legislature. That adds some degree of assurance that the taxes will, that the revenues from the new local tax will get to the local units of government that incur personal property tax losses. So in short, it's a concern by local governments that they want to realize the revenues promised to them that probably necessitate some additional hoops being jumped through in this case. Another frequent question is, will locals receive full reimbursement for their personal property tax revenue losses? Now, the reimbursement provisions in the legislation are intended to hold local governments harmless from revenue losses from the personal property tax exemptions. But there's no guarantee of full revenue replacement, and here we cite just a few of the risk factors for local governments. First, not even really a risk factor, we know this is the case. Some municipalities, counties, townships, villages will incur losses in 2014 and 2015 under the small property holder exemption. They will not receive any reimbursement for those initial years, which are taken care of through legislative appropriations. So there will be some early losses for municipalities with certainty. Only cities and certain tax increment finance authorities are going to be reimbursed for those early year losses that arise from the small property holder exemption. In addition, though, small personal property, the small personal property holder exemption is based on a one-time calculation in the legislation. It's basically the taxable value of the relevant personal property in 2013 minus the taxable value in 2014. Should a community have a new business entity move into its area and bring in some new personal property, that would sort of artificially make its small personal property holder exemption appear smaller than it probably really is. So in that case, there may be some examples of communities that may not receive the full amount of their small personal property holder exemption reimbursement because of things that are happening outside the norm. Also, revenue for reimbursement is based on those revenue targets in the legislation, and those are based on estimated losses to localities. Once those items that are guaranteed 100% reimbursement that we discussed earlier are reimbursed, other losses to local units of government will be reimbursed to the extent that revenues remain available to meet those losses. So it's possible that not all those losses will be met. It's also possible that governments could actually be over-reimbursed because they will receive a share of all of that revenue, even if actual losses are smaller than what were projected. Finally, it's worth noting that the proposal and the conversion of the state use tax has some potential for significant impact on the state's general fund general purpose revenues. The state general fund general purpose revenues are the state's discretionary revenues that help fund a variety of different state services, the corrections program, Medicaid program, higher education, all receive large shares of the state's discretionary GFTP revenues. Those revenues will be reduced as a result of two elements of the reimbursement plan. First, the new local share tax will take away state use tax revenues that otherwise would have gone to the general fund. And then secondly, as we noted earlier, the legislation requires the state share tax to be used to make deposits to the school aid fund to help offset state education tax losses and local school operating losses. So both of those take revenue out of the state's general fund and move it for other purposes. The new state essential services assessment that we discussed earlier helps to mitigate some of those GFTP revenue losses, but not all of them. The legislative analyses at the time that the legislation was enacted estimate a net impact on state GFTP revenue of $107 million in fiscal year 2016, growing to $350 million in fiscal year 2017, and up to $500 million in fiscal year 2023. So the proposal will have that price. It will be reduced state general fund general purpose revenues. So finally, in closing, we'll take a look at the implications of your vote on August 5th. If voters approve Proposal 1, the enacted personal property tax exemptions go forward. A portion of the state's use tax is then converted to a new local share tax. But again, no overall change in the tax rate for individuals, and in fact, the tax change will largely be invisible to us as consumers. Local governments will be reimbursed from the local share tax revenues. And again, as we discussed, those are projected to roughly hold local governments harmless from the PPT revenue losses, although, as we discussed, there are risk factors there. If voters reject Proposal 1, The personal property tax exemptions are repealed in tax year 2015. Businesses then go back to paying the local personal property tax again. There would be no offsetting state essential services assessment. The state use tax remains at 6%. There'd be no new local tax, no new authority to distribute that revenue. And local reimbursement then becomes a moot issue, and it is not needed and would not be facilitated. So with that, I am hopeful that this information was useful to all of you in evaluating and the proposal 2014-1, and will be useful to you as you go to the ballot box on August 5th. We may have some questions, so I am going to turn it back over to Eric, and we'll do our best to cover your questions today. Thank you for joining us.
Thanks, Bob. I think that very smartly covered all the issues related to the personal property tax question. We have gotten in one clarifying question. The ballot language says that the amount going to the school aid fund will increase. How can that be if the same percentage, 2% of the use tax, is deposited there? Hang on.
The amount from the state going to the school aid fund will increase. And when we talked about the cost of the proposal, it's in the reduction to the state's general fund. Part of that reduction, the hit that the state is going to take to its general fund, is going to be because some of that general fund needs to be diverted to the school aid fund, not so much to give a windfall to the school aid fund, but to make up for the losses to the school aid fund. So if I understand the question correctly, the school aid fund is going to take two hits. It's going to lose state education tax revenue, and local school operating villages are going to take a hit, which is going to mean that the state school aid fund needs additional expenditures to make up for those local revenue losses. The additional revenue going into the state school aid fund makes up for both of those losses, and it comes out of existing state revenue, basically. So the revenue going into the school aid fund is going to be less revenue available to the state's general fund that could have been used for some other state purpose.
All right. The next question, do you know an estimated number for the losses that will be incurred in 2014 and 2015?
There are estimates of those losses, and perhaps we can follow up after. I do not have them at my fingertips right now. Our focus, since this paper and the webinar today is on Proposal 1, much of our report focused on the reimbursement in 2016 and beyond, but certainly there are losses attributable to the small personal property holder exemption in 2014, 2015. I think the legislative analyses provide those numbers, and again, as we said, only some of those losses will be reimbursed. Some municipalities will receive no reimbursement at all, but unfortunately I don't have those numbers with me, and perhaps we can try to get those out to folks.
And the related question to that, is there any way to determine which local governments would probably lose revenue due to the large number of under 80,000 businesses?
You know, I have not seen any unit by unit analysis of that, so I don't have an answer to that. I have not seen information that looks at individual local unit impacts of the small personal property holder exemption.
As the formulas are set in legislation, does that mean the legislature can change them anytime they choose?
They can, as long as they have the votes. Yeah, I mean, the formulas are in the legislation. They aren't this isn't a constitutional amendment. They're not going to be in the Constitution. If the legislature wished to revisit the formula used for reimbursement, and they had sufficient votes to pass both chambers and get that enacted, also, of course, would have to be signed by the governor. They could do that. Yes.
Why is it that the general fund losses over time will not be, that there will be general fund losses over time that will not be made up? Also, why is the governor appointing all 5 members?
As to the governor appointing all 5 members, I can't answer that. You'd probably need to ask the legislature the rationale for that, and the bill. Certainly they could have taken other approaches to that. The general fund, the question was, why are there general fund losses again, Eric? Yeah, so the general fund losses come from 2 things. First, so we have an existing state use tax. 2/3 of that goes to the general fund. So what's happened here is we've created out of that existing state use tax a new local tax, taking a portion of the existing 6% use tax, and of course then a portion of its revenues will go to the new local tax. The legislation ensures that that impact does not affect the 2% that goes to the school aid fund, only the 4% base that's deposited in the general fund. So when you take a portion of that 4% tax base and create the new local tax out of it, the revenue will follow. So the state loses essentially revenue that's in the general fund now that is would be available for, I should say in the future, that would be available for other state purposes, will now go to the local tax and will be used for reimbursement of personal property tax losses at the local level. So that's revenue that now won't be available in the state's general fund general purpose accounts. The other factor is that the state, this legislation says the state shall deposit revenue into the school aid fund to hold it harmless from losses due to the state education tax and local school operating millages. So those 2 things combined mean state revenue that would be in the general fund and GFTP revenue will go to the school aid fund and to the new local share tax. And that precipitates then the state's GFTP losses.
So this is a follow-up to that first part of the answer you gave. Can you explain what the 5-member panel that will be part of the special authority will do, and what recourse do the voters have with any decisions that are being made since they're being appointed by the governor?
Yeah, I probably can't speak to a large extent to that. The functions of the authority will be fairly limited. They collect the revenue from the local share tax. They distribute the revenue from the local share tax. They follow the statutory guidelines and formulas to do that. They also then, of course, will take on this telecommunications right-of-way responsibilities. So in terms of decision making as to how we do this versus how we do that, there may not be a lot of it, but the legislation did provide that those 4 council members will be appointed by the governor. The only recourse that citizens have who would be concerned about that would be to approach their legislators and say, look, we need to change the makeup of this council, this authority council.
I have a few questions here that are kind of related. Have to do with the loss to the general fund and the revenue for the general fund. Has there been any plan put forth for how the general fund projected losses will be replaced. A related question to that is that Michigan business tax credits have been either repealed or are expiring. Will these mitigate the impact of Proposal 1 on the state's general fund? If so, do you know by how much? And a third related question here, how big of a loss will it be to the general fund? Can you put it in perspective in some way?
Okay, let me try to take all three of those. Replacement of the general fund losses is, well, I'll take the first two questions because they're related. There's been in the public dialogue and in legislative intent language, it's directly in the legislation, and we discuss it in our ballot issue report. The legislature has expressed the intent that these expiring Michigan business tax credits are intended to, the revenue that will come from the expiring credits is intended to offset the losses to the state general fund. Now, I'll note it does not appear at this time that they will completely offset those losses. The House Fiscal Agency just 2 days ago, I believe, put out its analysis of Proposal 1. I wish I had that at my fingertips, but I believe they suggested that they thought that even if you say accept the premise that these credits are replacement revenue for the general fund losses that are related to the personal property tax exemptions, you'll still be short by, I believe it was in the range of maybe $50 to $100 million across different years. So the expiration of the credits was not going to generate a sufficient windfall to completely offset the general fund losses that would come with the personal property tax reimbursement plans that are part of the legislation. As we looked at it, I can say the key fact is though the expiration of those credits are going to happen regardless of the PPT legislation, and they're going to happen regardless of how the vote goes on Proposal 1. So to some extent, that's revenue we're going to have. So we've looked at it from the perspective of, we're going to have this revenue. If we go forward with the PPT exemptions and reimbursement plan, that revenue will go. Some of that revenue, some or all that revenue will go to facilitate the reimbursement to locals. If not, it will still be available for something else in the general fund. So we really look at it as the reimbursement needs under this personal property tax exemption plan have a direct impact on the general fund. The MBT credit repeals will certainly help. That's new revenue that's coming down the pike. We know about it though. It's already current law. It's already in revenue estimates. But that will help. It'll help mitigate some of it, although not all of it. In terms of the percentage of the general fund, down the road, we're looking at $500+ million. If you don't try to count any of the MBT credit expirations, if you take that as, we have that revenue, and just look at the direct impact of the redirection of general fund revenue to facilitate local reimbursement, which is what the $500 million is once we get to fiscal year 2023 and beyond. $500 million, maybe the general fund is up to $10 or $11 million at that time, could be 4 or 5% of the state's general fund as a percentage, probably something in that range to quantify it.
Thank you. We have a clarifying question. The larger firms will enjoy a phase out of the personal property tax, but there will then be a new state tax on personal property?
That is correct, and the general purpose of that new state essential services assessment, the new state tax, was to help mitigate some of these general fund losses that we were just talking about. I think the millage for the state essential services assessment will be 2.4 mils on the acquisition value, not the taxable value, the acquisition cost of the new property. I've seen folks who have talked about the issue say, probably businesses will see a cut in the range of 80 to 85%. Instead of paying 35 mils on the taxable value of the property, I'll be paying 2.4 mils on on my acquisition cost. If it's newer personal property, they'll still get about an 80, 85, maybe 85+% reduction. But yes, in short, yes, this new state tax is a tax on the exempted personal property, and it will essentially be a smaller replacement tax for the larger local millages that these businesses are paying now.
Another question, I think we dealt with this a little bit before, but just to go over this, the personal property tax is a statewide tax. I think what we're saying here, the new local share tax is a statewide tax which is levied locally. Can the legislature simply repeal the tax without any revenue replacement?
Again, if the legislature, this is a these are all statutory provisions, so if the legislature has the votes to do that and can pass, open up these public acts and make those changes, pass the House and Senate, and get a gubernatorial signature, then yes, they could do that.
How will this impact other special taxing authorities such as park authorities or things like that? Will they be reimbursed as local governments and schools will?
If I understand the park authorities, I know like tax increment financing authorities are treated specially, but these would be just like any other, like a library, like a community college. They would be part of the non-high priority reimbursement, and they would receive reimbursement to the extent that revenues remain available from the local share tax. They would get a proportional share of the reimbursement through the statutory formula.
All right, we're winding down. We're just going to take a few more questions here. I think this is an important thing that people are interested in, the effect on the general fund and how all this plays out. So let me see if I can summarize these. If there are increasing losses to the general fund that will not be made up, what happens when the revenue is lost? What are the budget implications? What if the economy turns bad and there's the state general fund is in deficit? So let me leave.
Okay. We don't know definitively what the impact of the general fund losses will be under the proposal. That will be determined in future budgets. In short, there would have been revenue otherwise available in the general fund that now would not be available in the general fund. Somewhere down the line, budgets are going to be a little bit smaller. Does that mean the higher education budget is smaller, the correction budget is smaller, the human services budget is smaller? We can't really know the answer to that. definitively those decisions, the legislature, future legislatures will be operating under slightly more constrained resources and will have to enact slightly smaller general fund budgets in the future, and that'll have ramifications for all departments and programs that rely on the general fund to some extent. If the economy turns down, the general fund usually would decline as well. That's separate from this. We know what this specific proposal, we know roughly what the impact will be on the general fund. So I wouldn't speculate, but if general fund revenues started to fall in and of themselves beyond what's happening in this proposal, that would simply make those budgets a little more constrained. So it is an important insight, I think, that voters will evaluate the merits of it. Just because something has a cost doesn't mean it's not a good idea. Voters can decide on the merits of these personal property tax exemptions and the arguments made by proponents that this promises some business vitality, promotion of business investment, against the revenue cost, the price of this policy change. So we try to make sure we discuss that here.
All right, again, trying to summarize a few questions into one. Is this mostly designed to attract new businesses? And related to that, your analysis regarding the loss of the general fund revenue ignores the impact that this particular tax relief may have on business investment and economic growth, particularly manufacturing investment in the state. Could that result in increasing tax revenues?
Definitely the supporters of Proposal 1 have pushed it as a boon to business investment and to the economy. I think it's fair to say if you reduce the cost of investment in business capital equipment, that makes businesses slightly more likely to make investments in business capital equipment. Could it have a positive impact on the economy? Yeah, I think it could. Will it have a major impact on the economy? That's hard to say. I mean, if you look at it, we aren't completely eliminating personal property taxes. There will still be the state essential services tax. So you're getting a reduction in local personal property taxes that are going to provide some extra incentive to invest. Will that have enough of a ripple effect statewide to offset the general fund losses? I would say probably not. And I think the other thing that you have to remember is, since we have a balance, but we're not the federal government. We can't deficit spend in order to try to stimulate the economy. So you are reducing business costs, which should spur business investment to some degree at least. At the same time, you're using revenues from the general fund to reimburse locals, so they're largely kept whole. But the state general fund revenue, go bury it in a hole. That's spent as well. That goes to Medicaid providers and universities and state employees, and they spend money too. So there'll be that spending won't occur, and that will take away a little bit from the economy. So in the end, it's probably unlikely that maybe the personal property tax alone can generate, the personal property tax exemptions alone can generate economic activity, but that boon to the economy will be offset by the lack of public spending somewhere else that also contributes to the economy. We can argue about what has the most bang for the buck. That may be different, but you'll have things going in different directions with the economy in the big picture.
As of today, does the 4% amount of the use tax collected equal the total personal property tax collected? Can you put the kind of the magnitude of the use tax versus the PPT?
The whole use tax, no, the use tax would generate much more revenue than the personal property tax losses. Only a small portion of the use tax will be going to the new local tax to help offset the personal property tax losses. And what will that be? I see you're asking the proportion of the what will likely be the original rate of the local share tax. I haven't done the calculation. Yeah, well, that's something. Maybe we can follow up on that as well.
All right, Bob, thank you very much for your time and your expertise. I think these were all a very helpful presentation, as well as a healthy exchange of ideas with the question and answer. The last question I will field myself. Is this session being recorded, and where can we download the recorded session? So it takes a few minutes after this is completed for me to process it, to get it on the internet, and then to create the link. The intent is to have it on our website by the end of today. That should be both on our homepage, the first page when you pull up crcmich.org, as well as we have a little link up on the top left corner for presentations, and it will be there. You can download the PowerPoint presentation as well as the listen to the recorded session. I think it will also be, we have a link there for ballot issues, state elections issues, and we'll put it there too, so people looking for information about this stuff can see our radio interviews. We were on Flashpoint with Devin Skillion on Sunday, and we'll also put this recorded webinar up there as well. So thank you all very much for your time and your attention, and if you have any follow-up questions, you can direct those to R. Schneider at crcmich.org, E. Lufer at crcmich.org, or call us at 517-485-9444, 734-542-8001. Thank you all, and have a good rest of your day.